Welcome back to our channel. Today, we're diving into a topic that affects all of us: inflation. You've probably heard about it in the news or felt it in your wallet, but what exactly is inflation, and why does it go up and down? In this video, we'll break it down for you in simple terms. Let's get started. Section 1. What is inflation? First things first, let's define what inflation is. Inflation is the rate at which the general level of prices for goods and services rises, leading to a decrease in purchasing power. In other words, when inflation is up, your money doesn't go as far as it used to. Economists typically measure inflation using price indices like the Consumer Price Index, CPI, or the Producer Price Index, PPI. Before we go to second section, remember to like the video and subscribe to the channel. Section 2. Causes of inflation. Now, why does inflation happen? There are several key factors that can cause inflation. Demand pull inflation. This occurs when the demand for goods and services exceeds their supply. Think of it as too many dollars chasing too few goods. When consumers have more money to spend, and the supply doesn't increase at the same rate, prices go up. Cost push inflation. This type happens when the costs of production increase, leading businesses to raise prices to maintain their profit margins. Higher costs can come from rising wages, increased prices for raw materials, or higher taxes. Built-in inflation. This is linked to adaptive expectations. If workers expect prices to rise, they demand higher wages to keep up with their cost of living. Businesses, in turn, raise prices to cover the higher wage costs, leading to a cycle of wage and price increases. Monetary policy. Central banks, like the Federal Reserve in the U.S., influence inflation through monetary policy. When they increase the money supply, it can lead to higher inflation. Conversely, tightening the money supply can help control inflation. Exchange rates. The value of a country's currency can also impact inflation. If a currency weakens, imported goods become more expensive, contributing to higher overall prices. Section 3. Why inflation goes up. Several factors can drive inflation up. Economic growth. When the economy grows rapidly, demand for goods and services increases. If supply can't keep up, prices rise. Increased money supply. When central banks print more money or lower interest rates, there's more money circulating in the economy, leading to higher spending and demand pull inflation. Supply chain disruptions. Events like natural disasters, pandemics, or geopolitical tensions can disrupt the supply chain, reducing the availability of goods and pushing prices up. Rising wages. When workers negotiate higher wages, businesses might pass on these costs to consumers through higher prices. Higher production costs. Increases in the costs of raw materials, energy, or transportation can lead to cost push inflation. Section 4. Why inflation goes down. Inflation can also decrease due to several factors. Economic slowdown. During a recession or economic slowdown, demand for goods and services drops, leading to lower prices. Tighter monetary policy. When central banks raise interest rates or reduce the money supply, borrowing becomes more expensive, and spending decreases, reducing inflation. Improved productivity. Advances in technology or more efficient production processes can reduce the costs of goods and services, helping to lower prices. Lower costs of inputs. When the prices of raw materials, energy, or labor decrease, production costs go down, which can be passed on to consumers as lower prices. Strong currency. A stronger national currency makes imports cheaper, which can help keep domestic prices in check. Section 5. The role of central banks. Central banks play a crucial role in managing inflation. They use various tools to control the money supply and influence interest rates. For example, open market operations, buying or selling government securities to influence the amount of money in the banking system. Interest rates, raising or lowering the benchmark interest rate to make borrowing more or less expensive. Reserve requirements, changing the amount of money banks are required to hold in reserve, affecting how much they can lend out. By using these tools, central banks aim to keep inflation at a target rate, which is usually around 2% in many developed countries. This target helps maintain price stability, fostering a predictable economic environment. Section 6. Inflation and your money. So, how does inflation impact your personal finances? Here are a few ways. Purchasing power. As prices rise, your money buys less. This is particularly hard on people with fixed incomes. Savings and investments. Inflation can erode the value of your savings if the interest rate on your savings account is lower than the inflation rate. On the other hand, investments in stocks, real estate, or commodities might provide a hedge against inflation. Wages. If your income doesn't keep pace with inflation, your real income, purchasing power, declines. Debt. Inflation can be beneficial for borrowers if their wages rise with inflation but their loan payments remain fixed. However, if interest rates rise to combat inflation, new borrowing can become more expensive. Section 7. Historical examples of inflation. Let's look at some historical examples to understand how inflation can vary dramatically. Hyperinflation in Zimbabwe. In the late 2000s, Zimbabwe experienced hyperinflation, with prices doubling every day at its peak. This was caused by excessive money printing and a collapse in production, among other factors. The Great Inflation in the 1970s. In the United States, the 1970s saw high inflation due to a combination of oil price shocks, rising wages, and expansionary fiscal and monetary policies. Deflation in Japan. Japan has experienced periods of deflation, falling prices, since the 1990s, caused by a combination of factors including an aging population, stagnant economic growth, and a cautious monetary policy. Section 8. Current trends and future outlook. Currently, we see varying inflation trends globally. Some countries are grappling with high inflation due to pandemic-related supply chain disruptions, increased government spending, and other factors. Others are experiencing more stable prices. Looking ahead, the outlook for inflation will depend on numerous factors, including economic growth, central bank policies, technological advancements, and geopolitical developments. Economists and policymakers will continue to monitor these factors closely to ensure that inflation remains at manageable levels. Inflation is a complex and multifaceted phenomenon influenced by various economic factors. Understanding why inflation goes up and down can help you make informed decisions about your finances, whether you're saving, investing, or planning for the future. Thanks for watching. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to our channel for more content like this. Leave a comment below if you have any questions or topics you'd like us to cover in future videos. See you next time.